And this is a trade example. This is in the book, don't get me wrong. However, I feel it will be more powerful if I run over it with you. So this right here is to ensure that we are on the correct page, on the right page together before moving forward. Trading 101 is quite an important section, to be honest, and we want to ensure that we're covering the majority of aspects before moving on to the technical stuff. So if you sit there, or let's say maybe you're doing some chart work, some family come over, friends come over, peer over your shoulder at your laptop and think, or maybe even ask, what the hell are you looking at? How do you read this, etc., etc., etc. Now, there's many films out there. There's a lot, to be honest, online, which overcomplicates chart reading, overcomplicates how money is actually made and extracted from the FX market. Well, not just the FX market, but other markets or world markets in general. Basically, what I'm trying to say here is that this component, this factor of a trade example and the introduction into money management, which I'm going to give in a moment, is vital, and it's going to save you so much time going forward. People who study the markets off their own accord, with information found online and so forth, me being one of those, this information right here, it can take you months and months and months to actually work out and piece the puzzle together for yourself. So trade example, this is as you can see, this chart right in front of us here, this screenshot, this chart screenshot, this was from the original Astro FX book, and it was a live trade I took when the book was being put together. Now, this is an hourly time frame. Obviously, the trade came from the higher time frame perspective and so on. And this was actually the last leg on Euro USD, all the way up to 1.4 before the huge decline that we've seen over the past 2 years. Now, I'm not going to go into the full gist of everything right here as to why I entered the trade, because that's not too important now. I'm just going to go into the pips. I'm going to go into relating that to our account size. I'm going to relate that to a little bit of risk reward as well, and how to work out your pound per pip and profit. So we have the trade example. Now, as displayed in the below example, the buy entry is executed at the price 1.3714. The target for this trade is 186 pips. Now, the target is not displayed on this page. That came from the higher time frame perspective, so it's up here somewhere. All right. So as I've mentioned on the prior videos, please, please, please look at the market, dissect the market, break the market down, and look as to where the market can potentially go, where it could potentially run to before getting fixated on how to enter. So in this case, I've weighed up the trend. I've looked at the weekly, I've looked at the daily. We can see higher highs, higher lows. The next key level barrier is 1.4, and it's around 186 pips away from the current market price. So what I'm going to do in a moment, I'm going to pull up the whiteboard again. So let's say the account size is 5,000. To stay within our boundaries of risk money management, it's recommended that we only want to be risking 2%, which is £100. Obviously, 3% would be 150, 1% would be £50. 2% is a wise figure, as it would take 50 bad trades to wipe out the whole account. Now, if you stuck with the risk parameters and the money management parameters right here, and even if you flipped a coin, I don't think you will get 50 bad trades in a row unless you're extremely, extremely unlucky. Now, we've established the total risk, which is £100. So this is important because, especially when you're going forward, okay, you can say to yourself, every trade I want to do, I'm going to risk 2%, 1%, 3%, and work that out in your head. To work out 1% of a figure, all you have to do, guys, is, if I pull the calculator up here, so 5,000, and we want 1%. To find out 1% of any figure out there, we divide it by 100, equals 50. If you want 2%, you obviously times that by 2. If you wanted the 3%, you times that by 3. Simple as that. Get your balance, get your figure. We're going to be going through some of this together anyway in the next section on money management, but that's how you do it. Work out 1%, divide the figure by 100, times it by 2, 3, or 4 to get your 2, 3, or 4%. Easy as that. Now, the chosen stop loss for this trade is 60 pips, and I've put it just below the support level, 15 to 30 pips below the support level. So before I even entered the trade here, I know my risk figure, I know my target, I know my stop loss. Now we need to work out the lot size for the trade, which is pound per pip. Now what I'm going to do firstly, I'm just going to draw all of this on the whiteboard. All right, so I like to do this in steps and express this in steps. So I'm going to go into step 1, step 2, step 3. This is going to be covered later on. So as I say, it's just an introduction just to get your neurons firing and ensure that we're all on the same page. So step 1 is our risk figure. Now our risk figure, because our account is 5,000, our 2%, which we're comfortable with, we've already worked that out, remember? Our 1% is dividing the figure by 100. To get the 2%, we times it by 2. So what is it? It's £100 in this case. We're going to be working in pounds here. Okay, so every trade going forward, if we know that there's a potential that we're going to lose £100, nothing more, we are not going to have a heart attack. This is going to prevent you from jumping into trades that don't make sense afterwards, okay? So that's that. Next, we have, obviously we have our 186 pips, which I'll get to in a moment. But step 2, if we look at step 2 is our stop loss. Step 2 is stop loss. 1 is risk amount and figure, 2 is stop loss. In this case, it is 60 pips. It's going to differ on every trade setup, and you're going to know by the end of this course how to configure your stop losses. So step 3 is our pound per pip. Now, by the way, what I'm just going to put underneath here is our potential. I said 186 pips in the book. I'm just going to say 180. So this trade setup is a 1 to 3 risk reward. It makes sense. Cover this later on, but it makes sense. We're risking 60 pips to gain 180, and we're risking £100. But before we go ahead and click buy, we need to know the pound per pip. So that's where 3 comes in. Step 3. So all we have to do is step 1 divided by step 2 equals step 3. Okay, so we now need to work out the relevant lot size for the trade. So £100, which is our 2% risk amount, divided by 60, our stop loss amount, equals 1.60. You can do this on a calculator. So that's £1.60 per pip. Now, in the next set of videos, I'm going to go into converting this into MetaTrader lot sizing and so forth, but that's your trade. So you're going to buy the Euro USD, you're aiming for 180 pips, you're risking 60 pips. You are prepared to lose 2% of your balance, which is £100. You want to click buy and you want to enter £1.60 into the broker. Okay, putting it simply. Now, with that being said, due to the 1 to 3 risk reward, if you still don't get it, we're risking 2% for 6%. Okay, let's see how this trade went. So we bought the Euro USD, £1.60 per pip, 60 pips stop, target is 186 pips. 1 to 3 risk reward, this is the aftershock. As you can see, Euro USD did appreciate in value, so the euro gained strength against the US dollar. And in this case, we bagged 161 pips because we had an area of resistance above. Now, there's various reasons as to why we can take profits early. If you're happy, there may be news coming out. You may see some news in an hour or so. Your trade has ran the majority of its overall length. Okay, or whatever you've projected, and you want to say, cool, there's nothing wrong with taking profits. Nobody went broke taking profits. Or you can bring your stop loss, because you can modify stop loss after and then trail it manually. We're going to go through all of this later on. So anyway, I was happy with 161 pips, took that off. Now this is still the hourly time frame, and there's 33 candles here. So this is 33 hours, just over a day, to do 161 pips. So remember, we entered at £1.60 per pip. So 161 pips multiplied by the lot size of £1.60 equals £257.60. That's the profit on a 5k account. Obviously, we didn't let it run to 180, so off the top of my head, that is around a 5.5% gain on the £5,000 account. Now, this one trade that took over a day to earn £255, the larger your account, the larger your trades. For example, if you had 50,000 in your account and you wanted to risk 2% on 50k, that trade's profit would have been 2,500. Obviously, scaling up the lot size, scaling up the risk, scaling up the volume in conjunction to your account balance. So guys, that's a calculation there. Thought I'd run over this just to ensure that we're on the same page. So there's 3 steps, 1, 2, and 3. I'm going to cover this later. I'm going to go through examples. And it also helps, there's a section in the book as well about money management. But as I say, I'm going to relate this to risk reward and so on. I just wanted to do this to ensure that we have an idea as to how we can relate pips, charts, account balances, risk reward, pip sizes into profits, okay? 5.5% gain in the space of over a day. Remember, we can relate that to banks and what's out there in terms of our investments. That is some top class stuff. Okay, hope you enjoyed the video. Let's move on.